possible moves in the market from yesterday's participation from all the different algorithms, banks, hedges, and all that. So we look at the different market profile values and find out where there's gaps in the market. And we have a big gap below 84 and a quarter down to the control point of 97. So real big gap, 53.98, almost an 84, 85 point plunge to the control. So we'll keep an eye on that. If that breaks out, the other breakout would be 55.50, 55.51 or so. So we'll keep that up. I'm going to skinny that down a little bit. All right, let's go take a look at the markets, what we're going to attack today. Let's go yesterday review a little bit about yesterday and about these demand zones, supply zones, and so on, etc. So let's take a look at what a demand and supply zone is and how we can utilize it with the with our liquidity grab trader using a strategy, or you can use your strategy entry or manual entry, up to you guys how you want to do it. So what we have, let me get this off here real quick. Yesterday, we started out in the morning and we started trending. So what we have is we have our, let me get a big arrow to make sure we're on the same page. All right, so this is I'm showing in the room a 1-1-30 chart. 1-1-30 chart, just so you know, for you members, 1-1-30 chart in the trade room, Uni Renko. And what we have this green dots when you turn on the strategy. This is the SymmTick liquidity grab trader. So the Sim liquidity grab tick trader, that's the only one we don't want to use. You don't want to use a close. You want to use the tick strategy trader. So the SymmTick liquidity grab trader. So the zone, when you turn it on, it's going to give you a red zone or green zone. This is a 30-year back-tested zone. So over the past 30 years with an algorithm and an AI program, we found out that this is the best zone for trend that reverses the S&P. We tested on the S&P. All right, so since we know that if it's green, we're looking to be net buyers. If it's red, we're looking to be net sellers. Now, we have a dual trend filter that's available for us on the chart, which we have a workspace you can download, or it shows you how to put this workspace together on the members download page so it looks just like this. So what happens is, what we want to see then is we want to see our trend. It's going to be either green or red, uptrend or downtrend. This is going to base the trade decision on, all trade decisions based upon the tick strategy will be based upon this trend. If it's green, it's going to buy. If it's red, it's going to sell. The strategy will not buy unless you have a V. So if it's going to uptrend, it won't take any counter trend trades, meaning it won't take any red candle pullbacks, any V tops. These V tops, it's only going to take V bottoms. V bottoms with trend. V bottoms with trend. V bottoms with trend. So once a V bottom occurs, that is when you're going to get to the strategy will look for the first. It's going to look for the first. I'll put this on here. It's going to look for the first liquidity grab. It's going to look for the first liquidity grab after the V top. So here's your V top. V bottom, sorry, V bottom. And then it'll look for the first distortion in price. And then we'll get long. Now, under the strategy, you can put a total dollar amount. I have a $350 total target price for one contract and a $350 stop loss per one contract. Once it enters a trade, it's going to give you a stop line, a red stop line, and a red profit line. That red stop line that comes across is based upon that $350 stop or that $350 target. So in other words, once it gets in, you can trail this. You don't have to, you can trail your stop, not at 350. You can bring it up to $200, $150 stop loss, what have you, just by clicking and dragging it and letting it go. So you can trade off of just one chart. All right, so if you wanted to look for runners, what some traders are doing is they'll put an X amount of dollar amount per one contract stop loss that they want, and then they'll triple the size of the profit target, and that way when they get in, they can chart trader and move their stop up once they starts moving, and to reduce risk as you're trying to get up to your overall profit target. So let's say if you have a profit target, let's say $600 per one contract and a stop loss of $200 per one contract. If that's your strategy, after you enter, they'll just click on that red stop line and they'll move it up as the trade progresses. But the algorithm, what it'll do, it will only take trades in the direction of this zone trend. All right, zone trend. Now what happens is that you get pullbacks in the market. So the pullbacks in market are these demand lines. So we have two demand lines that are demand and supply. Supply be red, green is demand. So you're in a hard trend up if these are all green, because I have two pullbacks in the market that the market likes to pull back to. I have this level, which is my shallow pullback demand line, and then I have this level, which is the hash mark, which is a deeper pullback. So price, what you want to see, if this is green, you'll want to see it come down inside of this zone with it being green and all being green, and you want to look to get long with the VTOP and the liquidity grab strategy to get long and manage the position up. That's your optimal trade. That's your most optimal trade you're going to get in the room, because the reason being, these levels are deep liquidity grabs, because what the market likes to do, the smart institutional money and so on, what they'll bring the market down, grab liquidity, take all the counters out in one of these boxes, and then they'll just drive it to the upside. Now, we talked about this yesterday at 8:30 to 9 o'clock. I said, once we come down in this zone, you don't want to break. You can break inside the zone. You don't want to break outside of it. If you break inside of it and then it stays inside the zone and you get a V bottom inside of it, look for a big push in the market. I said it can run a good 5, 10, 15, 20 points, typically around 10 points in about 15 minutes on average sometimes when it comes down these zones, if you're in a 9:35 to 11 o'clock time frame. And that's exactly what we had yesterday. It came down to it, I'll show you, and then it ran up really, really hard after I got done talking about an hour later. So that's how you want to trade the system. So how can we utilize, there's two ways you can trade the liquidity grab strategy. If you want pinpoint accuracy of only trading deep liquidity grabs, where the smart institutional money is bringing it all the way down into these zones, and if you see the zones is in and you get a V bottom, you can turn your liquidity grab trader on and let it manage that position, because you're only going to get a few opportunities during the day. We've had, 5 or 6 of them yesterday that occurred, but the day before is like 15. So it depends on the trading day, but you get some nice sizable possible runs where you can manage the position. So you can do it that way, or you can use larger Renko sizes. This is smaller Renko sizes in comparison to a larger Renko size, like a 1150, 1190 or so on. Larger Renko size you can let run around the clock. You don't want to run smaller Renko sizes around the clock because there's too many retracements, right? So you want larger Renko size if you run around the clock. If you're looking to just sniper trade, where you're looking for these markets to get inside of these deep pullbacks into deep liquidity grab zones, and then use a strategy to let it enter, manage, and you can trail the position. That's what a lot of traders are going to be doing with the strategy. So when we start moving up, then this is a very strong market, because if you got my deep liquidity grab pullback, which is the hash, my shallow liquidity grab pullback, which is our dual trend filter, these two need to match up if we're in a hard trend. But if all three match up, green, 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 that's a triple trend. That's triple trend, meaning our liquidity grab zones are all green with our 30-year back tested zone. So this is a hard trending market. If you see this all green or all red, and you're getting shallow pullbacks that do not break inside of my 38 zone, right? Because I use a 5438. If it doesn't break inside my 5438 zone, you are catching a lot of counters that are getting taken to the woodshed. This is called short covering. A lot of short covering, because they're getting all these buy stops are getting hit above these highs. If you see that, you're going to look for a nice push in the market. So when we're all green, it all lines up green, you're in a hot market. You're in the hottest market possible in that market that you're trading. If the lower one, the hash mark, is red and these two are green, you're intermediate, right? You're intermediate, meaning it's still warm. The market's still warm. If these two are red and this is green, you're in a cold market. I mean, it's in an uptrend, but it's not in a hard uptrend. So when you look at these filters on this, you can trade off just one chart. You know right away if you're in a hot market. If you're in a hot market, this is a time to turn on your liquidity grab trader and let it just keep trading. As long as we're staying above the shallow retracements, which it does, and we're all still green, this is the best time to keep the liquidity grab trader on all these. You can just leave it on, not even turn it off and on, and let it turn on right when it turns green, and it's going to try to pinpoint these blow-off trades, blow-off rallies, because you're catching a lot of wrongly positioned traders. So when traders ask me when's the most optimal time to let it run and turn it on, when all these are green, all three green, when all three are red. You take on more risk on the liquidity grab trader when you have our 30-year back tested zone is green, this is red. You're taking on more risk. You're taking a lot of risk on when only this is green and these two are red. Because what you're saying is, you're saying the market is the temperature of the market is cold if these two are red and this is green. So if they're all green like yesterday, if you guys had a liquidity grab trader turned on one contract, the results were quite remarkable. If you look at them yesterday, it just kept taking trade after trade after trade. Now, what if you have all green or all red? Look for a zone pullback, and this is key. If you want to try to pinpoint when the optimal turning point on the S&P is after, let's say we've been running, and I talked about this yesterday from 8:30 on video to around 9:30. We talked about it. I said eventually we're going to get a pullback to a demand zone, and the market could explode possibly 10 points or more in a short 15-minute period. We did exactly that. The market finally broke down below my 30-year back tested zone. It got below it. So for these demand zones to hold, here's my shallow demand zone. Here's my deeper demand zone. When price is retracing, what you want to see is get this into big red. You want to see price hold these zones. And I'm not talking one close outside the zone nullifies the trade on a pullback. So when we start pulling back here, here's the first demand zone. Comes inside of it. If I would have V-bottomed in here, it would have been a buy. Does not do it. Start closing outside of it. Once it closes a candle or two candles outside of it, it's done. Then it closes one candle inside of it. Let me blow this up. It closes one candle inside of it, and I talked about this zone an hour before it happened. I said, look for the market to move hard on the first demand zone it hits. This has been a hard uptrend. Here's your pullback. It closed one close inside of it. It can close two, and close three, and close four. It just can't close below the outer zone here, the dashed line. If it closes below that dashed line, then you don't have the zone's not holding, right? So this is timing our deep liquidity grab right here perfectly. We wait for the V-top to occur. This is when you can turn on your strategy, right? So you can use two ways. You can turn your strategy in hot markets when they're above all green, 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 green. This can make your week right here, guys. You guys saw the results yesterday that I showed, and it was trade after trade after trade all the way up. It had one loser in the beginning, and then it got 1, 2, 3, 4, 5, 6, 7 trades in a row just off of that move up. And then we had the deep retracement, and look what happens. We come down into the demand zone. The demand zone is hit. We get a V top, a V bottom. Now that we have a V bottom, this is where you can activate the liquidity grab trader. Let it run for you. Remember, you don't want to run the liquidity grab trader around the clock on smaller Renko sizes because there's too many retracements. You only put it in the ideal situation. You can do this off the 1-1-20 using this technique, the 1-1-25, the 1-1-30, the 1-1-35. I show 1-1-30 in the room. But this is the optimal time to use a strategy to try to get this run. Now, like I said, a lot of you can put this target price way up here, $600, $800 target price with a $200, $300 stop loss, and just trail your position as it starts moving. Because you can, it's like chart trading. You can click and you can trail it. But the point is that first pullback was a possible big run. So that pull, that V top bottom came in at 64 on this Renko size. To compare a 1-1-20, it came in at 61, 54.61. The market moved up to 84. It moved 20 S&P points. There's 1050. Moved all the way up there by almost 11:15, 11:20. So 15, 20, 25 minutes later, it moved 20 S&P points. Because these demand zones can reject price like that. Market keeps going. Comes into a what? It doesn't come into demand zone. It comes into just a V bottom with trend. Is it a hot market? No. I mean, yes, it's a hot market. It's all green, I'm sorry. But is it above our outer zone? No. So it's not hot. It's not super hot market because it starting to retrace. So it comes down inside, right? So then we start getting all the way up, still looking for trades. It comes into, that's a hot trade because you're outside the outer zone. It's all green, right? Then we come into the deep zone again, right? We've only had we had two deep zones earlier, sell and a buy. I just showed you the last one. This is another big zone trade. Why? Price comes down inside of the deep zone. This is how they catch traders. There's a deep liquidity grab inside the zone. Closes one candle inside, closes back up. Market gets a nice run. And then all of a sudden, you get a run from the 93 on the 130 chart, on the 120 chart. It filled at 91. The high was 02. We had another 10 points on the S&P in a matter of 7 minutes. 10 S&P points. I'm finding when we come these demand zones, supply zones off the 1-1-20, you typically run around 10 points on a run. Then it comes back down. It's still green, all green, which is conducive to a trending market. We get another move to the upside. Here's another one. Another move to the upside because we're all green. This is conducive to a winning strategy because we're the two deep liquidity grab zones are green. My 30-year backtested zone's green. It's triple trend filter saying we're going higher. Remember, you take risk on, guys, if this is red. If one of these are red, you're taking on more risk if it's not all green because it's not a hot market. Market comes down. Look at that deep retracement. This is how they catch liquidity grab traders. This is how they pull back to grab liquidity to catch counters. So counters are drilling the market, right? We keep drilling the market. Counters are drilling the market. Comes right into the zone again. Now we're into the zone. It closes closes inside the zone. Okay. And then it gets a close up out of the zone. And then this was 96 3/4 on the 1-1-30. And the 1-1-20 was a couple points less. So it would have been 54.94 3/4. Got as high as 06. So it just ran another 10 S&P points. And that was in a matter of 15, and then 7 minutes again, another 10 points. So when you're doing these guys, when you're doing these pullbacks, to these zones, they tend to run in these zones based upon that type of environment that you're in, right? Now you can put this indicator base all by itself if you want. So we can put that indicator on one chart, or you can leave it on the top of these charts. We have it on these charts. So they're on top of these charts for you. But you can put them on an indicator on each individual chart if you want. Which I'll show you. Let me show you real quick. So if you put it on a blank chart, the indicator, it looks something like this, where you get your demand zone on pullbacks. The idea is this, is you're catching you're trying to catch a rolling position traders on a pullback with trend. All right, this demand zone. So what they do is these algos will pull the market back. They'll pull it all the way back to these zones, grabbing liquidity from these counter trend traders on the way down. And now that they grab liquidity, it needs to stop right inside that zone. You cannot close outside either this zone. Even if it breaks this zone, you're looking for it to buy this zone. Then you're looking for a pump in the market. And right when it did it, this one yesterday was a 61. This is a 1/120 chart. It's a smaller chart. We show in the room a 1/130, but the 1/120 have a smaller stop, 1/120. The zones are still the same for 1/120, 1/130. You just have a smaller stop. You can get away with the 1/120 and get a $200 or $150 stop loss per trade. You can even get $100 per one contract on a 2-point stop. Works on the 1/120. Even a 2-pointer on a $100 stop off these demand zones, and then the market pumps from 61 to 84. So you can use this as an indicator if you don't want to. If you only want to trade the liquidity grab tick trader for zones, you could just trade them off the zones to increase your accuracy and only look for zone trading. Right? Because these are smaller charts. You can't just turn on the liquidity grab trader tick trader and say, hey, let me just take all these retracements. You don't want to do that, because it's going to take all these buys and sells. You're going to get way too many pullbacks of V tops and V bottoms. What you can do is you can say, hey, I'm going to wait until the smart money pulls this market back to demand or supply zone when I'm all red or all green. And I'm gonna use that automated system to manage my position to get me in, and then I can trail this thing all the way up depending on what Renko size you want to use. But you can go, I wouldn't go less than a 1/120. 1/120 works good with these demand zones like this. So you can use a 1/120 or whatever zones that you prefer to use. On the 1/120, but you just have to make sure you understand that when you're doing these trades, is that if you're using automation, which we're going to get into a lot next week, we're going to do a lot of market replay. I'm going to show you how can you do full automation on this thing. Also, by using my SymmRenko as a trend filter, by using different Renko sizes, by changing the tick, offset, and tick trend. By next week, by next Friday, you're going to get a really good handle on how to use this system. You can either do pullbacks with trend and hot markets, like either turn it on in hot markets only and let it just go to work. It happens on a week-to-week basis where you get in hot markets like this. where these are all green and you are above, price is above. It's very simple. If my outer zone and my inner zone and my 30-year backtest zone is green, you're in a hot market. What's going to happen? You're going to get shallow retracements. All these VTOPs should be shallow. 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 Boom. Shallow. Run. Shallow. Run. And when you see that happen, that's when I have market profile in the room. It's typically when you break outside of market profile. So in other words, what I'm saying is when I put these gaps in the market up from previous participations in the market, previous participants, this is where you want to turn all red, all two zones and my 30-year backtest zone red. Because guess what? Shallow retracement sell, shallow retracement sell, shallow retracement sell. You're just going to see big boom, 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 boom right in a row. It makes your week because the algo just sniper trades and picks off all those short side markets. Just like yesterday. What happened yesterday? Yesterday, this HVA moved up, but it was down here when it broke out. And it was just like all above HVA. HVA was down here. It's like buy, 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 all the way up. It was buy, 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 buy. It broke out. This is our HVA in the morning right around here. And it's above it. And these are all buy retracement, buy retracement, buy retracement, buy retracement, buy retracement. It caught all of them, right? Because we're in a hot market. It was all green, green. The market was conducive to running hard. This is all green. Our market profile broke out. So when you're going to see these all green, all three green or all three red is when what happens? When you break out a market profile. Because this is where you're catching the wrongly positioned traders. Because all these buys in here will get caught and all the sell stops are going to be resting right below 54.84 today, 85. And we should have a run all the way down to 5,400. You're going to see a market that if it turns all red, you're outside the outer zone. That's when you can let the algorithm do the work and go to work if you're using smaller Renko sizes with your smaller stops. All right. Consequently, you can also look for these demand zone pullbacks as a way to get into with the algorithm. Okay. And the strategy as far as doing that, as far as that goes.